Let's get the week started live from New York City this morning. Good morning, good morning. Your equity market just about positive by 0.3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Chair Powell taking the spotlight in Jackson Hole, why some of the biggest bond bulls are still bullish, and the latest moves in China leaving investors confused. We begin with the big issue. Over to you, Chair Powell.
A lot will depend on what Chair Powell decides to do.
Chair Powell.
Commentary out of Jerome Powell at Jackson Hole.
It will really come down to Powell to be on message.
He's got a fairly important balance to take.
He will probably recognize some of the progress that we've made on inflation.
Inflation's coming down, and that's a great thing for the Fed.
But at the same time,
the data flow since the July FOMC has been very strong.
The consumer is strong.
They can't declare premature victory.
I don't really think that we're going to hear a big change in narrative.
He's going to reiterate the fact that the job's not done.
To reiterate this view that they could stay higher for longer.
Powell's going to talk hawkish.
Skew slightly more hawkish.
Powell has to keep his options open.
Keep the optionality open in case they need to hike more.
This is a very, very data-dependent Fed.
There's nothing else that we can say at the moment until we get more data.
Let's kick things off with Morgan Stanley's Alicia Shatter alongside Samir Samana of Wells Fargo. Lisa, beginning with you, and good to see you as always. What are you looking for from the Fed chair on Friday?
Well, look, I do think that your highlights kind of captured the direction. I think we're going to get some encouragement on the one hand that progress is being made, but some realism on the other hand, that says we've got a long way to go and that, we are not yet comfortably and confidently at the 2% target. I think as some of the guests that you featured noted, optionality is going to be what the Fed wants. They claimed that they are going to be data dependent. And I think that they need to balance the message overall.
Samir, there's some suspicion that maybe on Friday there's a discussion about that long dot in the dot plot, that neutral rate. Do you think this is the time to endorse a higher neutral rate?
It's possible. And, I was about to say that, I think we've left the part of the story where the Fed drives this narrative. And I think we are now at the point where it's more about the long end. So I'm not sure whether it's one more hike or two more hikes really matters to markets, but I do think it matters what, the 10-year trades at, what the 30-year trades at. And, look, if they found a home or at least they start to slow down here, I think you've got a market that could at least chop sideways. If they push further into the 4.5%, maybe even 5% range, then I think you've got a real pressure on the multiple side.
It matters to Mike McKee. Mike joins us now with a look ahead to what you can expect from central bankers in Wyoming later this week with Fed Chair Jay Powell scheduled to speak at 10:05 Eastern Time in Jackson Hole. Mike joins us now. Morning, Mike.
That's the interesting part about it, John, is economists who are attending and central bankers who are attending are looking forward to 3 days of discussions about all kinds of economic issues. But it's the morning speech by the Fed chair that will get all of the attention on Wall Street. It is going to be an economic outlook, according to the Fed in their schedule for Powell this week. These are the speeches he's given in the past. They have been essentially economic outlooks. I call last year's whack upside the head because that's what he did to the markets about rates staying higher for longer. We'll probably get more of that this time. Interesting, go back to 2019 and 2018. He was talking about this long expansion and how we're going to keep it going, not knowing what was in store in 2020. But a lot has changed in the past year for Jay Powell and the Fed. The economy has gotten much, much better. You can see the big decline in inflation. It's now below the unemployment rate, and both of those are in the threes, even though the Fed has doubled the Fed funds target. So he can take some consolation in that and maybe take a little bit of a victory lap. But again, I think Lisa was right. He's going to warn people we're not done yet. These are the other central bankers who are speaking, as well as as Jay Powell. They've all announced their appearances. So it won't be just Powell, but investors in other continents will get some information from Christine Lagarde, Ben Broadbent, the Deputy Governor of the Bank of England, and Kazuo Ueda, the Governor of the Bank of Japan. So a lot to look forward to. But again, it's that half hour when Jay Powell speaks on Friday, John, that is going to get everybody's attention.
There's a question that Citi are asking already this morning. Andrew Hollenhorst over at Citi Mike asking this question. I'll share it with you. How will Powell balance the optimism about recently slowing inflation together with the reality of continued upside risks to growth, Mike? How do they manage that issue?
Pretty much the way they have so far. In his news conference, in the statement, risks are tilted, yes, but as long as we keep interest rates higher for longer, we're going to be able to bring inflation down, and we're going to do that. I don't think he gives any indication of a policy shift. Right now, the markets have priced out a September move, but they still have some options for November, and Powell will probably stress those and the fact that we're not going to see rates come down anytime soon.
Mike McKee, full coverage from Mike and the team through the week. Looking forward to it. It concludes with Jackson Hole on Friday. We'll all be there. Just to give you the fuller quote from Andrew Hollenhorst over at Citi. How will Powell balance optimism about recently slowing inflation with the reality of continued upside risk at Jackson Hole on Friday? The answer to that, quote, may determine if the sell-off in long-term bonds continues or fades. The bond bulls right now still bullish. JP Morgan's Bob Michael saying this: whether the US economy enters recession or a soft landing, the bond market rallies after the last rate hike. The Fed may keep rates at these levels for quite some time, but growth and inflationary pressure continue to slow. Lisa Shallett, you've been talking about this for a while. Is now the time to go out further along the curve? Look at 10s at about 430, maybe even go further out to 30s.
Yeah, no, I don't know that I'm ready to go out to 30s, but I'm certainly willing to add some duration here. You know, one of the things that we have counseled our clients on is that when you take advantage of some of the rates that we're seeing in money markets, when you take advantage of some of the rates at the front end of the curve that have breached 5%, you risk what we call reinvestment risk, meaning that over the next 2-year horizon, those rates may be lower. And one way to balance that is to begin to build a barbell into your fixed income allocation and add some duration, capturing some of the yield in that 5, 7, and even 10-year bucket.
What's the argument against that, Samir? At the moment, housing seems to be in recovery, commodities are rallying, the labour market's still tight. Do we really face that reinvestment risk in a more pronounced way at the moment?
You know, I mean, I think it is a good time to add duration, but we also like short-term fixed income. So I think you can kind of park a little bit of money in both. I mean, really, it's probably the intermediate part of the curve that probably has the most repricing to do if the Fed does stay up here. I think the other thing to note, too, is, there's still some inflation-sensitive assets like commodities, which have been hit pretty hard. So that's an area that we still like. So I think you can still kind of try and play, kind of a bigger barbell with respect to, if there is a recession, those long-duration assets will do very well. And if somehow we continue to muddle along, if there is a soft landing or no landing, then inflation surely will reaccelerate, and then commodities will do pretty well.
Samir, no sign of that recession just now, is there? I know that Neil Dutta, Renmac, others asking whether we're sufficiently restrictive. Do you think we are?
I think we are sufficiently restrictive. I think the tricky part is, unfortunately, it's all those buffers, right? It's all that fiscal spending that's still in the pipeline, and it's all the kind of savings that are still on personal balance sheets. Now, I think there are signs that the personal balance sheets are starting to come under some duress. You can see that in a lot of the consumer credit numbers. And then I think the fiscal spending, it will wane, but that might be more of a 2024 story.
You clearly like the risk reward of the bond market at the moment, Lisa, but do you think we do face an extended period of higher for longer interest rates of this Federal Reserve?
I do. I mean, I think, without getting too wonky, when we talk about higher for longer, I think part of what we're referring to is what is that neutral rate. So it may be that rates come in a bit in the soft landing or economic slowing scenario, but where do they, fall to? And one of the key things that we've talked about is we don't think that we're going to return to a 10-year that has a 1 or a 2 in front of it in terms of yields, and that from here, the downside to yields may only be 100, 150 basis points because longer term rates start to reset higher. And I think as your other guests this morning have noted, that reset of interest rates has material implications for stock valuations. We've been in this era that has supported near 20 times forward price earnings multiples over multiple years, and people have begun to get very comfortable with those as valuations. But when you really, kind of pound the calculator and do the numbers, those kind of valuations on long duration assets are only sustainable if you believe that the long run cost of capital on risk-free rate is somewhere around 2. If suddenly it's 3 or 3.5, the numbers don't work and multiples revert to where they've been really over the last 60, 70 years, which is a lot closer to, 15, 16, 17 than to 20.
Elisa, you're raising a really good point. And Samir, just to extend that one further, if the bond market is starting to adjust to that reality, the reality that Lisa describes, how far along in the adjustment process is the equity market and credit, given what you've seen on the screen in the last couple of weeks?
Yeah, I mean, look, you've got markets all over the place. You've got markets like, I would say, small caps, which have started to adjust. You've got certain sectors like energy, materials that have started to adjust. We actually like materials. Commodities, I think that's another area that's pretty much priced for a recession. But then there's other places where you wouldn't know that there's any type of slowdown, right? I mean, if you look at high yield and you've got spreads still at 400 basis points, and you're looking at and seeing, all right, what must they be thinking? I mean, there's some idiosyncrasies with respect to a high weighting to the energy sector, which was doing okay before oil collapsed. But again, I mean, you've never had a slowdown or a recession without high yield not blowing out, much above, 600 to 700 basis points. And I just don't know why people would be buying high yield today when you can replace a lot of that yield on the investment grade side.
Elisa, what's the response to that at the moment? If you looked at high yield spreads, there's nothing to see here. Is there something to see here?
Yeah, I mean, I agree with Samir. I think that the something to see here is how unbelievably complacent, these spreads are, and how, they are building in a forecast of stable corporate cash flows. And again, while we're not suggesting that corporate earnings are going to collapse, I think that the reality is that stress on margins as we go through this period, even of a soft landing, are material, and that access to financing, the constraint on lending from the banking system is going to start bubbling through to the rest of the economy. And we do think ultimately these spreads are going to reflect a little bit of that duress.
Lisa Shallett, Samir Samana, sticking with us about 20 minutes out from the opening bell. Just to get you up to speed on what's happening in the bond market, that sell-off resumes. Yields are higher by 6 basis points, 4.32 on a 10-year. On a 2-year, just short of 5%, 4.98. I think we can call it 4.98 right now. Yields are higher there by 3 basis points. Equity futures positive by just 0.2%. Let's get you some movers. Here's Abby.
Lots of tech movers on the move this morning, John, to the upside, starting out with the shares of Palo Alto Networks. This is one of the rare cybersecurity firms that has done very well after earnings. They reported very oddly, in fact, on Friday after the bell. But you can see the stock absolutely soaring up 12.5%. They beat some of their cloud offerings doing well. And what's really juicing investors is the fact that their billings guidance for the year much stronger than expected. VMware up about 5%. The UK has cleared Broadcom's $61 billion acquisition of VMware. And then NVIDIA, they, of course, report Wednesday up 2.4%. More and more analysts are raising their price target, defending this stock after it fell recently. The big question is, will they do a repeat of the last quarter? May 25th, John, this company added $143 billion in market cap, the largest amount by any company ever on a single day on that huge guidance. Will they do a repeat performance? Well, we'll find out Wednesday.
Abby, thanks for that. Coming up on this program, China's latest efforts leaving investors confused.
There's only one policymaker, that's Xi Jinping. And when you have one policymaker who's interested in not only preserving the economy, but also preserving his own position and consolidating power, there's only one set of solutions, which is you gotta get the private sector under control. And that, unfortunately, is their Achilles heel.
Damian Sassa of Bloomberg Intelligence coming up next, together with Lisa Shallett of Morgan Stanley and Samir Samana of Wells Fargo.
right now, I think they're pretty constrained. And when the renminbi is dropping like a rock, it's very hard for the central bank to be dropping interest rates. This is truly a situation where monetary policy is pushing on a string. When everyone who has lost confidence that the private sector can be survivable, we are asking them to go borrow money at even 5 or 10 basis points. That's not going to make any difference at all.
Milken's Bill Lee weighing in on China's latest moves. Banks making another surprise move overnight, keeping one-year mortgage reference rates unchanged and making a smaller than expected cut to another rate. The moves highlighting the ongoing balancing act in Beijing as it tries to boost borrowing and maintain stability. Damien Sasser joins us now for more. Damien, can we just start with what happened overnight? Walk me through what happened and what didn't happen.
Okay, so last week, the PBOC decided to cut its medium-term lending facility. This is usually a precursor to these cuts in the medium lending facility, which we actually didn't quite get overnight. We basically saw no cut to the 5-year LPR, the loan prime rate, which is basically a proxy for mortgage household lending. And then the 1 year wasn't cut by 15 bips, it was cut by 10 bips, which was less than expected. So the market's reacting to that by the yuan selling off. So I think we hit a low of 731, rather a high on dollar yuan of 731. I think we're back down to 728 last, Jonathan. And look, this is just about, the policy levers that she is pulling not being able to overcome the property slump. I mean, look, the shift in growth, looking domestically, looking at light industries, looking at small and medium enterprises, looking at clean energy, it's just not able to overcome the growth drag from the property slump.
Ability and willingness. Damien, I think you've identified 2 key points here. Are you saying it's more about inability and less about willingness?
Well, that's exactly right. I'm thinking it's all about willingness. I mean, let's be very clear, right? When she decided, and Bill Lee's exactly right, Jonathan, it's President Xi with his finger on the button here. So when he decided to, kind of pull all the COVID restrictions, suddenly, that tells you everything you need to know about, who's pulling the policy levers, I believe, in Beijing. And he can choose, if he sees some unrest domestically, to do the same thing here, right? And to start flooding, stimulus into the economy. And that would obviously get demand and consumption back online. But we're just not seeing that this time around, and I think that's what has markets spooked.
We both know tons of people underweight China. Lots of people de-risked from this in the last couple of years, Damien, given that the action was elsewhere. What's the risk that this can spill over in a less direct way? Where are you seeing the potential for that?
Well, I think there is risk, certainly, but I think some of the risks are a little bit overblown. I mean, the Zhongji trust debacle that we saw last week. I mean, let's just be clear. Trust assets, which, is a form of wealth management, a way for people to store their savings in China. It's really only $300 billion. Remember, China's reserves are $3.3 trillion. So, again, if they wanted to address some of these key issues that are impacting sentiment in the local market, they can do that. They've just chosen not to. So, again, to your point, Jonathan, this is all about willingness on the side of Beijing.
This story's not going away. It's just sort of lingering.
Never does.
Damien Sasser never does. That's true. Damien, thank you. Lisa Shallett, Samir Samana back with us. Samir, the US surprising to the upside, China surprising to the downside. That divergence, can that continue?
We think so. We've used the analogy for China for many, many years now, where basically it's like a driver with one foot on the accelerator and the other on the brake. Just when you think they're about to go into the ditch, they tap on the accelerator. And just when you think they're about to kind of take off, they tap a little bit on the brakes. Again, I think it's a very managed economy, and I think they have a growth rate in mind. They don't always necessarily share it publicly, but I think they always have a plan in mind. And I think you're seeing that plan kind of unfold. And look, I think there's a geopolitical aspect to it as well, where I think the Chinese are trying to reduce their reliance on, I guess, external funding, right? I mean, if you are possibly thinking about a conflict in the coming 2, 3, 5 years with, let's say, the broader capital markets, players, you probably don't want to be as beholden to them in the debt market. So I think, they're probably doing the bare minimum, but I think there's a geopolitical, aspect to it.
They're shooting for 5% GDP. Morgan Stanley has them at 4.7, Nomura at 4.6 for this year. It's a lot of companies, Lisa Shallett, on the S&P 500 with exposure to that downside surprise, that story, that weakness over in China. From your perspective, Lisa, do you think we can decouple, whatever that means? Can that divergence continue?
I think it's going to be very hard. I mean, the global economy, as we know, is extraordinarily interconnected. And while, we may only want to look one level deep and say, hey, what happens to China is going to affect emerging markets and then maybe Europe, I think that investors in the United States need to be honest with themselves and not only acknowledge the direct exposure of U.S. companies, as you noted, to China, but U.S. U.S. companies' dependence on sales outside the United States, right? Roughly a third of S&P 500 profits are being derived from outside the United States. So if we start having secondary and tertiary effects on Europe and other emerging markets, it certainly is going to hit American companies.
Lisa, do you see the weakness currently as an opportunity to buy?
This one, I would say it really depends on your time horizon. We have been, long-term believers, not only that China would right the ship, but that emerging markets would be a very good place to be over the next 3 to 5 years. The dynamics right now really do depend on whether or not the Chinese policymakers make the right choices. I think as many of your commentators this morning noted, there's a bit of this pushing on a string with their, desire to rely on monetary policy and relying on, cutting rates. The reality is that the Chinese household has a ton of excess savings. This is really about confidence and a crisis of confidence. Cutting rates is pushing on the proverbial string, in our humble opinion. And what's needed here is some pretty forceful fiscal stimulus that will boost confidence, perhaps some type of helicopter money type program like the United States did during COVID by literally mailing checks to small businesses and households.
Not seen that yet. Lisa, thank you. Lisa Shalad there, Samir Samana on the latest. The index story you did not expect to see in 2023. The S&P 500 up close to 14% year to date. The Hang Seng in Hong Kong in a bear market and down almost 11% year to date. Unreal stuff. Futures just about positive on the S&P. Coming up, the morning calls and later. 2 market moving events this week. JP Morgan's Jordan Jackson at the opening bell, looking ahead to Nvidia earnings on Wednesday and Fed Chair Jay Powell on Friday. That conversation still ahead. 4 days, no gains. Can we change that today? Equity futures just about positive. That's the price action. Let's get you some morning calls. First up, UBS raising its dear price target to 408, pointing to the company's better than estimated Q3 results. Evercore removing Peloton from its tactical underperform list, saying expectations are now largely priced in ahead of earnings. And finally, HSBC raising its Nvidia price target to 780, expecting shares to rally on the back of Wednesday's earnings report. That stock is up by 2.8%. Coming up, 1 week, 2 big events. JP Morgan's Jordan Jackson looking ahead to Nvidia results on Wednesday and Chairman Powell on Friday. That conversation up next. Your opening bell just around the corner. 4 days and no gains on the S&P 500, trying to prevent it from becoming day 5. Equity futures right now just about positive by 0.25%, coming off the back of 3 weeks of losses on the S&P, equal to the longest weekly losing streak of the year so far. There's the opening bell, switch on the board, the blame game in the bond market. Yields up again by 6 basis points on a 10-year, 431.80 on a 10-year. Real yields exceeding 2%. On 10s, the highest going all the way back to 2009. It's quite a game right now in fixed income. Think about the levels we've seen on a 10-year. The low intraday of the year so far, 324.77. That was back in April. That was more than 100 basis points ago. We were talking about the end of the cycle, hard landings and all of that bad stuff. And look at us now. In the FX market, the euro stronger, dollar just a touch weaker, 108.94 on that currency pair. In the commodity market, a lift here on crude, up 70 cents, up by 0.8%, $81 and about 90 cents on WTI. One stock to watch at the open, Palo Alto Networks, shares jumping after delivering a stronger than expected outlook. The CEO saying this: our strategy is resonating with a growing number of customers, adding that the company was pleased with the reception of its AI-based platform. Abby has more. Hey, Abby.
Hey, John. And the stock right now being rewarded, having its best day in about 2 years. And this, of course, after they reported adjusted earnings that beat. Revenue is basically flat relative to the quarter that was reported, but it's all about the outlook, as you mentioned. The billings growth coming in much stronger than expected. They're looking looking at 19 to 20% billings growth for fiscal year 2024. Solid growth, really beating rivals such as Fortinet and Checkpoint and even Cisco. This stock coming into today up 50%. Now it's up 64%. So this is one of the tech names that's hanging on to the gains, building them. One thing that's super interesting, of course, they reported Friday after the bell. It's been a long time since I've seen that happen. The last time I remember that happening was closer to 2002 when EMC essentially pre-announced. The company saying that maybe it was a mistake, and Dan Ives saying it was one of the worst PR disasters. Folks had been nervous that they were going to put up a bad quarter similar to EMC way back in the day, but not the case. A great quarter, good outlook. Again, stock is soaring.
Looks good right now at 14%. Abby, thanks for that. About 2 minutes into the session, up 0.25% on the S&P. Trying to hang in there on the Nasdaq, up by 0.4%. Plenty more on that move in real yields in America. I want to turn to the financials, though. Goldman said to be exploring a possible sale of its personal financial management business. This according to reportings this morning from the Financial Times. The bank saying, quote, "We expect to find an outcome that benefits both our clients and our advisors." Shonali Basak has more. Hey, Shonali.
John, it's the undoing of a big consumer strategy you're seeing over at Goldman Sachs. This is a business that was United Capital, a business Goldman Sachs acquired in 2019 for about $750 million. Now, remember, at that time, it had about $25 billion worth of assets. Now it has about $29 billion, so not a lot of growth there. The strategy here was to help ACO. This is the business that it serves corporate executives and their deputies. It was to get them closer not only to the corporate side, but to expand their wealth business more. But Goldman Sachs has had problems going downstream. We know that they've also been in talks to sell GreenSky, which they bought for even more, for $2.2 billion back in 2021. In the most recent quarter, they took about a $500 million or so goodwill impairment charge tied to that business. The overarching question with United Capital would be, are there more costs associated with unloading that business as they try to bite the bullet on the consumer and look forward?
Is it a good thing we're talking about strategy this morning and not personality, Shonali, after last weekend?
Sure is. Also in the Financial Times over the weekend is this story about Goldman Sachs CEO David Solomon retaining the board's backing in the middle of all these changes and in the middle of morale changes over at Goldman Sachs. They see it as external noise. Now, the next quarter or so will be the most interesting to watch.
Is that another way of just saying we blame the media? Nothing's to see here.
There's always a moment to blame us, like isn't there, John?
Sure. Always the way. Shonali, thank you. Just the reporting came from inside the bank. The sources were inside the bank anyway. Shonali, we'll do that another time. Let's turn to the EV space. Nikola warning it may not reach its full-year delivery target as it grapples with recent battery issues. This comes as it also unveils a $325 million convertible bond sale. Joining us now is Bloomberg's Simone Foxman. Hey, Simone.
Hey, John. Yeah, both of these announcements coming in 8K this morning, adding to the wild ride that we've seen in Nikola shares over the past couple of weeks. A bigger move even earlier this month. But on that $325 million sale of convertible bonds, we'll see the first $125 million tranche expected to close today. Those bonds yielding a 5% coupon plus interest to be paid in cash or common stock. Clearly, the concern here is that this could be dilutive, though obviously this is a business that takes a lot of capital to run. On that recall announcement, as well as those battery electric vehicles, this affects 209 vehicles. The company is saying it related to a leak inside a battery pack that's thought to have potentially been the cause of a fire. The company saying today that it may face significant expenses in order to fix the issue. No word on exactly when it can restart production of those vehicles. So that adding to lack of clarity around its delivery targets. We're seeing shares fall around 11% today, down about 19% so far this year, John.
175 right now on the screen. Simone, thanks for that. Thanks for the update. I want to turn to the chip sector. UK regulators approving Broadcom's $61 billion takeover of VMware, paving the way for one of the largest ever tech deals. The company saying in a statement, Broadcom is confident that the combination with VMware will enhance competition in the cloud and benefit enterprise customers. Katie has the story. Hey, Katie.
Hey, John. Yeah, brace yourself. Like you said, one of the biggest tech deals ever, potentially. That's after the UK's Competition and Markets Authority gave its blessing to Broadcom's $61 billion takeover of VMware. And the UK antitrust watchdog said in a statement today that the merger basically, it wouldn't substantially reduce competition in the supply of key computer server products. And the clearance comes after the European antitrust arm, of course, approved that deal back in July. And while we haven't heard yet from U.S. regulators, chipmaker Broadcom said today that the Federal Trade Commission's period for reviewing this deal has passed without a challenge. So we'll see there. If you take a look at the stock market, of course, this news is being met with open arms. VMware shares currently up by 5%. And this is what's interesting. If you take a look at Broadcom, typically the acquirer sees its shares fall, but currently Broadcom up about 1.6%, despite that $61 billion price tag, John.
Katie, thanks for the update. Big week for tech, actually. NVIDIA reporting results this Wednesday that may surpass consensus as a result of the AI frenzy, especially in its data center unit. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, massive quarter when they reported, what was it, back in May, with a huge lift to the guide. Can we expect the same thing again, Mandeep?
I mean, it's very unlikely that they're going to raise their guidance by another 50% this time around. But look, this is the only company in that, Fabulous 7 or Mega 7 stocks that everyone cares about right now that's growing over 50%. Everyone else is like high single digit to low teens growth. And it tells you something that they are a virtual monopoly when it comes to, this generative AI wave where everyone wants to use their GPUs for training the models. Whether it's going to carry through for the next 4 to 8 quarters, I think there is a question mark, because when you go back to 2 years back when crypto was doing very well, everyone extrapolated that growth. But that didn't happen, and that's where valuation kind of compressed. So clearly there is that risk, but right now this is a secular trend, and NVIDIA is a monopoly when it comes to training these models.
Mandeep, story of the year in the stock market, 200%, close to 200% gains. Story for Wednesday. Do you expect to hear from ARM before we get to Wednesday, Mandeep?
I think they will file their IPO. And look, there is that ecosystem that ARM and NVIDIA and TSMC have created in terms of hurting Intel's prospect. I mean, think of, how chips were consumed before and Moore's Law. And what these companies have done is created an ecosystem and a stack where everyone can customize their chips. And I think ARM's IPO would be quite interesting in the context of NVIDIA's results, given they tried to acquire ARM at one point.
Let's catch up tomorrow about that. What a story it's been for ARM over the last decade. Mandeep, thank you. NVIDIA right now up another 3.7%. If you're just tuning in about 8 minutes into the session, equities here hanging in there. We've had 4 days without gains. Day 5, maybe we can avoid that. Equities right now on the S&P up by 0.5%, on the Nasdaq up by 0.8%. In the bond market, so much to discuss. 2007, the last time we saw 10-year yields close at the levels they did last week on a 10-year. On a 30-year, we're talking about moves we haven't seen in more than a decade. 30-year right now, 444, 10-year, 431, real yields through 2%. Joining us now is JP Morgan's Jordan Jackson. Jordan, let's start there in fixed income. Is it time to lock it in, go further out along the curve and take a nibble at some of these pretty juicy yields that we haven't seen for the best part of 10 years?
I think so. This is some of the most, as you mentioned, some of the most attractive yield levels that we're seeing in well over a decade. Imagine if I came to you and said stocks are as cheap as they are in almost a 16-year time window. You'd be looking pretty interested at risk assets. And so we're seeing similar sort of resets in valuations in the bond market. This is looking really attractive as you start to look further out on the curve. And really what's important is the risk-return profile at current yield levels. I mean, even if you are worried that inflation is going to move higher, growth is going to continue to surprise to the upside. Maybe the Fed stays on hold even a little bit longer than what's already been priced in. You're probably looking at the 10-year flirting with 4.5%, not really a more material move higher from here. But if yields move down by 1%, you're looking at some pretty handsome capital appreciation coming from bonds. And again, that return profile is not symmetric. It's very asymmetric right now. So we think the risks are skewed towards pretty interesting, pretty profound bond returns over the next, call it 6 to 12 month time horizon.
So Jordan, this is the conversation right now going into Friday, anticipating Chairman Powell in that speech he delivers in Jackson Hole at 10:05 Eastern time. For you and the team at the moment, Jordan, do you expect him to endorse that higher rate for longer type story that we've been discussing all morning?
I think so. The reality is the incoming data just continues to be very, very resilient. And we may not be on the all clear in terms of this downward march to 2% inflation. We've now got to move higher in oil prices. Energy prices are stabilizing and potentially moving back higher, that feeding back through to gasoline prices. So we could see that headline inflation number continue to bounce around 3%. We also get PCE, the Fed's preferred measure of inflation this week. And that number is likely to have a slightly above 3% handle on it as well. So, I think he's going to try to be balanced as he possibly can, weighing the risks to the outlook, along with some of the more supportive measures as we've talked about. But I still think he's going to embrace that narrative of higher for longer, just given how resilient the incoming data has been.
With that in mind, where does that leave your outlook for equities now, Jordan?
I think we see a bit of choppiness, maybe some sideways markets over the next, call it 6 to 8 weeks, as we get a little bit more clarity on what the Fed is likely to deliver for the remainder of the year. But I do think, though, the Fed is going to embrace this idea that in falling inflation over the course of next year, gradually lowering policy rates, that's going to keep the real rate steady over the course of next year. But suffice it to say, if the Fed wants to stimulate the economy next year, they're probably going to have to cut rates a little bit more aggressively in order to bring that real policy rate lower. And I think at that environment, if they start to hint at that sort of language sometime in the fourth quarter of this year, I think that's going to lead to a strong interest rate rally coming out of equities. And that suggests that your long duration equities, your tech names could potentially perform well and lead the charge out of a period of sideways markets or period of weakness over the next couple of weeks. But then after that, as we've talked about, real policy rates are still going to be positive. The cost of capital is going to be higher. We're not going back to zero rates next year. And so I think where things shake out, you're going to want a little bit of growth, a little bit of value within the portfolio, and a certainly active approach in an environment where, again, rates are going to be higher.
Jordan, thank you for the update. Jordan Jackson there of JP Morgan Asset Management, about 12 minutes into the session. Equities positive here by 0.5% on the S&P 500, on the Nasdaq up by 0.85. We are doing this even as the sell-off resumes into the bond market. Just for an update there for you, on a 10-year at the moment, 4.32, yields up by 6 or 7 basis points. If you go to the front end of the curve, even there, very close to 5%, 4.98, yields up there by about 4 basis points. Coming up, high stakes ahead of the first 2024 GOP presidential debate.
Ron DeSantis has the most to gain and the most to lose from Wednesday's debate. Can he get out there and, project a coherent message for the Republican Party saying, I'm the future?
One thing we do know, the former President Donald Trump is saying he will not attend. That conversation up next.
I served alongside the president for a long time, and one thing I realize about him is not over till it's over. So right. I'm actually still hoping he shows up. I think every one of us that have qualified for that debate stage ought to be on the stage, be willing to square off, answer the tough questions, and also draw a bright line contrast.
Former VP Mike Pence speaking to ABC over the weekend, hoping Donald Trump participates in the first GOP presidential debate on Wednesday. The former president taking to social media to announce his decision, writing this: "The new CBS poll has me leading the field by legendary numbers." He goes on to write, "I will therefore not be doing the debates." The former president widening his lead over GOP rivals, according to the latest CBS News poll, with 62% backing Trump versus 16% support for a second-place Governor DeSantis. Let's bring in Bloomberg's Anne-Marie down in Washington for more. AMH, good morning.
Good morning, John. You could just see there from the CBS News poll that the former president continues to dominate in the polls, even though he's facing all these indictments. Actually, the indictments, many are saying, are making him a martyr. And they are just increasing his polling numbers, especially amongst the Republican base. His nearest rival, I should say not so near at this poll you're looking at, the CBS poll, 16% for Governor DeSantis, who has been falling in the polls, and Trump just continues to dominate. All of this, Jonathan, ahead of the debate on Wednesday in Milwaukee, where the former president says he will not show up. His reasoning is, why bother if he's leading so much in the polls? He says the American people knows what he stands for. But potentially, Jonathan, he will do some counter-programming on Tucker Carlson with an online interview. But this just means that on the debate stage,
we're going to hear from these other candidates now. And while Trump, yes, has a tendency to take all the oxygen out of the room, whether or not he's physically there or not, we are going to get to also some other policy issues with him not being there as well.
And to what extent will they go after the former president? AMH, a fascinating poll from CBS YouGov. Within that poll, away from the headline figures, this one right here, and I'm sure you've got a selection yourself, of likely GOP primary voters. Should Trump's opponents focus more on Trump or make the case for themselves? 91% making the case for themselves, 9% make the case against Trump. Does that give you some indication as to how this might play out on Wednesday?
Well, potentially, because what you saw in this poll is that what voters want to hear is they want to hear those policy discussions. They still remain that the economy and inflation is the biggest issue, and they want to hear what each individual has a plan forward for what they would do to bring inflation down and to make sure they have a plan about the economy. And they are kind of sick of hearing everyone give their remarks about the former president. Another interesting tidbit, Jonathan, from this poll, which was just fascinating, is that most voters believe Donald Trump is the source of truth. He has the most truthful information, even above their religious leaders and their friends and family. So these are individuals who really are not going to be backing away from the former president.
Or just very mistrusting of their own family, Anne-Marie, whatever you want to read into that. Governor Christie has talked a lot about what he doesn't like about the former president. Has he offered anything on the policy front?
Well, when it comes to policies, Governor Christie has really gone through a gamut of them. And there are some Trump policies that he did agree with, but he just does not think that the former president is fit for office. I think he thinks the Republican Party needs to move on. There's one policy point, Jonathan, we've been looking closely here at Bloomberg, and that is, of course, what any candidate, if they became president, would do with the Federal Reserve. They have this option in 2026 to appoint a new head of the Fed, head of the new Fed. We do know that Governor Christie, he has told us he doesn't think that Jay Powell's done anything horribly wrong, but the former president, VP Mike Pence, Governor DeSantis, they would all get rid of Jay Powell.
MH, we found some consensus on the debate stage on Wednesday. Looking forward to your coverage. Always am. Thanks, Anne-Marie. Appreciate it. About 21 minutes into the session, let's get you some sector price action. Here's Abby.
Well, John, after a 4-day slide for the S&P 500, we're finally looking at a gain right now, up 0.3%, so a modest gain. But nonetheless, we have good sector composition. More sectors than not are higher, led by technology, discretionary, and communication services. In other words, the mega cap tech stocks, they are really performing today. And at this point now, we've had some of those ones in the middle, energy and healthcare and financials, flip to the downside. Really to the downside, though, the dividend-sensitive sectors, staples, consumer staples, real estate and utilities, they look less attractive right now because yields are higher, offering competition to the dividends on those stocks. Now, the month of August right now, we're, of course, looking at the worst month of the year on some of this big tech slide, despite the fact that we have a rebound today. As for the worst sectors that we've had over the last month, it is discretionary, not surprisingly, and tech. But take a look at real estate and utilities in there. So sort of uneasy bedfellows in the month of August, some bad breath from the standpoint of the selling we've seen.
Banks have had a tough month as well.
Yes, indeed.
Given what we've seen in the bond market. Abby, thanks for the update. The sector breakdown on the stock market. Right now, we're doing OK, up by 0.8% on the Nasdaq, on the S&P 500, up by about 1/3% in the bond market. It's just been trouble, hasn't it, over the last month? Yields up again by 7 basis points, 432 on a 10-year, on a 30-year, up by, let's call it 6 or 7 basis points to 444, very close to 5% at the very front end at 498, going into Jackson Hole on Friday. This quote from DWS, George Catronbone, said this: "There aren't great reasons to front-run a hawkish Fed, additional supply, and very resilient U.S. economic data prints, all of that and more contributing to this sell-off we've seen in the Treasury market over the last month or so." Up next on the programme, your trading diary. I just love seeing Tico in that Columbo jacket in that Jackson Hole promo. Going to see more of that this Friday. 26 minutes into the session, equities up here just about. Let's see if this sticks. Here's your trading diary. Here's your week ahead. President Biden heading to Hawaii to assess wildfire damage in Maui. Then we get Zoom earnings after the closing bell. More results from Macy's and Lowe's on Tuesday. Then it's a busy Wednesday. Nvidia after the closing bell, followed by the GOP's first presidential debate in Milwaukee, Wisconsin. And finally, Jackson Hole kicking off on Thursday with Fed Chair Jay Powell speaking Friday at 10:05 Eastern Time. From New York, that does it for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day.